So, guys, recently the federal government of Nigeria recently signed a memorandum of understanding with Investoneer Academy to train 100,000 Nigerian youths each year in Forex trading. Yes, you heard that right. So, according to the Federal Ministry of Information and Orientation, training the youths with practical skills in forex trading, risk management, and financial literacy will help reduce the high rate of unemployment and promote financial inclusion. Now, trust Nigerians, as many took to X platform to comment and express their opinion on the matter. And here are some of the comments from some well-meaning Nigerians. So while some believed that forex trading is high risk, very volatile, and most often people sell it with a very unrealistic expectation, others were of the opinion that it was a solid move and a good initiative by the Nigerian government, and even suggested that they should include stocks and crypto trading as well. So now the question many are asking is forex trading a profitable venture? I mean, if it is, then why are most traders losing money? According to these statistics gotten from tradesociety.com, 99% of traders fail. It says only 7% of traders remain after 5 years of trading. 80% of traders quit within the first 2 years. 60% quit after 1 month of trading. And virtually all traders want to get rich quick. The truth is, more than 90% of traders lose money, even those that have been trading for decades. And the 10% that actually wins consistently have learned to beat the odds. Now, let me show you why many people lose in trading and how you can be part of the 10% that actually wins consistently. So guys, please make sure you like and subscribe and help this video get at least 1,000 likes. So without further ado, let's dive in. So the first reason why most traders lose money is because they have no real education. Now, many new traders jump into trading without learning the basics. They think by watching a few YouTube videos is enough. But to be successful, it starts with real education. And real education is not a 4 weeks or a 3 months training course. Of course, training courses are essential. Don't get me wrong here, but they are equally overhyped. Because if you're learning to trade just by watching courses, it's like asking maybe a soccer player, for example, to study matches instead of playing. No doubt you might pick up a few ideas, but you haven't experienced the emotional psychology that comes with trading. You haven't been hit yet. You haven't tested your reflexes. You haven't built instincts. And in trading, that's where the real growth happens, you know. When things get hard, you will easily believe the answer is in the next training course or the next webinar or the next guru's secret method. Or you would believe that maybe you haven't just found the right system yet, or maybe there's someone out there that has the exact formula you're missing. And that mindset is exactly what keeps the trading education industry going. But the truth is, there is no course or signal groups or indicator that can replace your screen time and personal execution, no matter how well they market it. Even the best tools are useless if you don't understand what they are showing you. If you blindly copy trades or rely on BOTs that you barely understand, you're not learning, you're just contracting out the responsibility. So, real progress comes from doing the work. When you start journaling trades, reviewing decisions, backtesting setups, you start building confidence through repetition and not theory. And the truth is, most of what you need to learn is already available on Google anyway. So the difference isn't access to information, it is actually what you do with it. So yes, education helps, but without execution, it doesn't change anything. So another reason is trading without a plan. A lot of traders go into trading without a plan. They think they have a plan, but what they actually have is just a habit of just opening the trading platform, scanning through price movements, and just jump into something that looks promising. They get into trading without having a defined setup and no system to repeat. They enter into a trade because the price is moving up very fast, or because they saw a call out on social media, or someone recommended a play on some WhatsApp group. They exit because they feel it's the right time, or because they panicked. Every decision they make is impulsive, and every outcome has a feel of luck. No, that is not trading. What they are doing is gambling. And that is why most people are of the opinion that trading is gambling. But serious traders don't operate like that. They operate differently. They know how to identify a good trade even before it appears. They focus on only specific patterns that make sense to them. And these are patterns that they have studied, tested, and refined. They're not just watching too many stocks at the same time and hoping that some magical moves may happen. They have already done their background work, filtered their lists to a few that meets their very strict criteria. If nothing meets those criteria, they do not trade. Their exits are also well planned. They do not exit trades impromptu. Every trade has a predefined setup, a predefined stop, a clear profit target, and a consistent risk per position. And so very often, they use the same amount of dollar on every trade. And because they follow a consistent approach, they are always reviewing and improving their plan. So when they are profitable, they judge the quality of their trades by how well they followed their plan and not whether they made money. So when you have such mindset, which of course takes time to build, it turns your trading into a skill that you can refine rather than some lucky guesses. And if you review and make changes every day, your results too will change. If you do not have a structure, you cannot improve. You can only hope things will go better next time. And hope in this game, my dear friends, is very expensive. Another reason is trading with emotions. Emotions play a big role in trading. So like I mentioned earlier, training courses are essential, but your instincts, your reflexes play a key role in your trades. Very often, traders experience a mix of emotions, and this often leads to overtrading and impatience. Fear and greed are your worst enemies in trading. When you win one trade, you get greedy. Then when you win a few more trades, you feel unstoppable, and then you keep going. But when you lose one, you begin to panic. Then you hit few losses and you start feeling desperate. So you start forcing trades that should not have been taken. This emotional cycle destroys accounts faster than bad signals. Overtrading doesn't always look reckless when you're doing it, because it makes you feel like you're being productive, because you're active, you're watching the market, you're doing something. But if you do not have a real setup behind the trade, it is just noise. And this is how most traders blow up their account. It is not from just one mistake, but from dozens of mediocre trades they take out of boredom, fear, or overconfidence. When they win a few trades, they become overconfident. And when they have a few losses, it triggers revenge trades. And each one takes away your capital and your focus. The market is not designed to reward activity. It only rewards precision. And top traders know this. They patiently wait for high quality setups, and they stay out of trades when conditions are not right or favorable. They don't force it, they don't chase it, and they're not afraid to end the day without any trades, if that's what the market demands. Because sometimes the best trades is no trade at all. So while it is essential to have a solid strategy, your psychology often plays a bigger role. Emotions like fear and greed disrupts your execution. So having emotional discipline is just as vital as your technical skill. The next reason on the list is having no risk management. This is the major reason why a lot of traders don't survive long enough to even learn. Most traders don't blow up accounts because of one bad setup. They blow up because they never defined how much they are willing to lose. If you ask a trader who is losing how much they are willing to risk per trade, they'll usually have a vague answer because their risk usually depends on how confident they feel or how they performed in their last trade. That is not a strategy. That is emotional exposure. Risk management is about putting boundaries before the trade even begins. It means that you know the maximum loss you can incur per trade, either as a fixed amount or a small percentage. You should set a stop loss that makes sense technically, not emotionally, and stick to the stop when price hits it. You do not second guess. So even if it was a false breakout that moved in the opposite direction of your trade, it won't really matter to you. You will only wait for the next setup to trade. And also, knowing when to walk away. So if you've had a set number of losses in a day or week, you walk away. Professional traders treat risk like a system. Some use 1% of their account and others use a fixed dollar amount. Either way, the point is the same. If the trade fails, it costs only a little. And if the next trade works, you can make more than what you lost. This is what gives your strategy breathing room. It means you can survive a bad day or even a week off, because then your capital isn't bleeding out from oversized losses. But just to be clear, risk management alone won't make you profitable. It does not replace your skill, your strategy, or having an edge. It just keeps you in the game long enough to be able to develop the skill. And the aim is not to win every trade, but to make sure no single trade can take you out. Now, the next reason is being over leveraged. So leverage in financial trading is when a broker allows traders to take larger positions with a smaller amount of capital. It is actually borrowing money from a broker to increase potential profits and losses as well. When traders use leverage, they can increase their position size in any asset without depositing the full amount. So instead of paying the full amount of the trade, they just put down only a fraction of the total value and the broker then provides the remaining balance of the capital. So it is effectively loading the trader the balance of the capital. Okay, an example is if a trader uses, let's say, a 10-to-1 leverage, then they can control a position worth $10,000 by depositing only $1,000, which is their margin. So the broker provides the remaining $9,000. But the thing is, leverage increases both profits and losses. A small increase in price can lead to a significant gain, but also a small reduction in price can lead to substantial losses and can even possibly exceed the initial margin. So that is what leverage is. Now, a common belief that is usually sold to traders, mostly beginners, is that you can start with a few $100s and grow it quickly. But that mindset is exactly what causes many traders to fail. Because when you have limited funds, you feel more pressure to make every trade count. So when they size up and use leverage, they begin to chase trades that could double their account. But one wrong move they make, and it is over. Not because their setup was bad, but because their size didn't give much room to accommodate any error. Then they go into an emotional roller coaster. They start forcing trades, they try to win all they've lost back. And just like that, their account is all gone. So you should know that if you do not have enough money or are undercapitalized, you do not need more risk. What you need is more time to learn. So you start with a demo account on a simulator and practice for like a full year. You build your strategy, track your results, and treat every decision like real money is on the line. Only after you have done that, then and only then you can consider trading live with small positions and, more importantly, money you can afford to lose. That's how you take emotions out of the equation and give yourself a real shot at lasting in the game. You don't need a big win. What you need is to last long enough to become good at trading. And the last reason I will share is following the wrong crowd. As humans, we have a built-in tendency to want to follow the crowd. And this is very common with a lot of traders, mostly beginners. They want to take the same position as everyone else. And surprisingly, this is one of the most common and profitable strategies in the market. Because if you look at some of the most followed companies like Tesla, Apple, Nvidia, and Microsoft, indeed, they have outperformed the underfollowed companies. And it doesn't only happen in stocks. It also happens in other assets like cryptocurrencies. You see the price of Bitcoin and Ethereum has been rising, and it's mostly because of following the crowd strategy. Even in currencies like the US dollar, which drops partly due to the same strategy. But following the wrong crowd can be unfavorable towards any financial asset. Just the same way teenagers are known for taking unnecessary risks due to peer pressure. Traders also can allow the opinions and behaviors of others to prompt them to make unwise decisions. Mostly new or inexperienced traders generally make this common mistake of blindly following the wrong crowd and then making bad trading decisions for themselves. They might run after hot stocks or stocks which are trending for no solid reasons. And they just jump into some trades just because other people are doing so. And then they end up with fake mentors and WhatsApp trading groups who promise them 100% return overnight. And these traders follow them because of fear and greed, or FOMO, which is fear of missing out. They don't want to be left out or left behind. And taking this approach when trading the financial markets will usually lead to losing money. Following the wrong crowd can cause traders to either buy the wrong asset or buy at a wrong price or sell it prematurely. So when traders follow the wrong crowd, it can cause them to make mistakes by influencing them to enter and exit positions based on fear and greed rather than facts. And going into trades without proper fundamental or technical research can prove to be fatal. So do your own research. This is one of the most frequently used terms in trading circles, and for good reason. No one should make trading and investing decisions without doing their due diligence. But unfortunately, this happens very often. Now let's talk about the 10%. So the real question you want to ask is whether the results this 10% who are exceptionally good are seeing are a matter of luck or skill, or both. Now let's use Warren Buffett as an example here. Warren Buffett has had an exceptional investing career. Is he skilled? Very much so. Did he have some luck too? Sure, he did. So, if you can muster both great skill and luck, you too might be the next Warren Buffett. To be a consistent, profitable trader is not an easy task. And since the 90% failure rate continues to grow, so if 90% of new traders are blowing their accounts within 90 days of their trading, how can you avoid blowing your account and have a high win rate to be consistently profitable? Well, the traders who win consistently follow this formula. So the first step is learning one strategy well. Profitable traders don't go chasing 10 indicators. They just master one setup and stick to it. Those who master one strategy will always have a significant edge because they understand what every tick, every candle, and every pattern represent. So when you focus on the patterns and setups as it unfolds, you can react swiftly and with precision and stay in sync with the market instead of fighting it. You must remain disciplined in your approach. Avoid falling into the trap of searching for a secret indicator. It's not out there. Instead, you should focus on developing one strategy and look for ways to improve upon the execution rather than always changing strategies. And the next one is building a trading plan and following all the rules. The number one downfall of beginner traders is not having a trading plan. You must define your trading plan. Your trading plan should be so clear that you could explain it to a 5-year-old. What every professional and profitable trader will tell you to do is plan your trades and trade your plan. They write down a trading plan, which will include their trading strategy to guide them in their trading, and then they follow the plan strictly. Your plan tells you when to enter a trade and when to exit, how much risk you can take on every trade, what times you will trade, what stocks or currencies to trade, as well as guidelines for when you should not trade. You don't change anything in your plan and in your trading strategy. No matter how many losing trades you take in a row, you stick to your plan and stick to your strategy. To be a profitable trader, you must have rules that you must follow. Each rule must be designed to keep you out of trouble, and you must follow it every day and every time you trade. Even when you've had a couple of losing trades in a row, you don't change anything. You will eventually make all the losses back and be in profit again. So sometimes the market might just go against your trading strategy, but you have to stick to it because the market will correct itself in the longer run. The next one is practicing in a demo account. Yes, for beginners most especially, you need to and practice in a demo account first. Traders who win profitably practice like crazy, but they only practice what is in their plan, nothing else. You don't trade real money until you've made fake profits first. It is usually advisable to practice trading in a demo account using fake money in a simulator, that is a virtual trading environment. So it looks like you're really trading, but you are not losing any money. And this is where you get to learn how to trade, develop, and backtest your trading plan and strategy. Backtesting is when you run your trading strategy against historical data to measure how well it performs. So it's not just about knowing that your strategy works, it's about understanding under what conditions your strategy excels and when it struggles. And many traders skip this part because they want to get straight to the making money part. I understand, but the reality is you're more likely to lose money. If you haven't backtested your trading plan and strategy to prove that it works, then you're not going to be confident in executing it. And especially for traders who use funded accounts from prop firms, backtesting is even more important because capital is allocated based on performance and evaluations are very strict. So a well backtested strategy gives you the confidence to execute your trades with precision, knowing it has been validated under various market conditions. Because in the prop trading environment, there's no room for guesswork. Only proven strategies survive. And the next one is managing risk every trade. Just like everything else in life, trading comes with risk. And if you don't control risk, you won't last long. Being a profitable trader doesn't mean you won't have losses. Even the most seasoned player experiences losses. What profitable traders have is a good risk management. So instead of focusing on trying to generate a profit on each trade, they focus more on trying not to lose on each trade. And there is only one way to be a profitable trader, and that's by keeping your losses small and manageable. You will surely have losses. They are not avoidable, but they are manageable. The best traders have lots of losing trades, but they know when to get out. And remember, you can only control the size of your loss and not the market. So the next one is keeping a trading journal. Think of a trading journal as bookkeeping for traders. So if something is going wrong, you will be able to identify it, improve on it, and continue to build your trading edge. Profitable traders usually track their results. They journal every single day what they did and how they did it. Your mindset, the situation around you, your environment, all plays a key factor in your overall success in trading. So when you document your trading journey, it helps you to see areas you need to improve on, and you can see over time the mistakes you did that resulted in your losses. You will be able to see your pitfalls, from the anxiety to the gambling, or you doing too much, or not being focused, not having a trading plan, or just jumping in and hoping to get lucky and expecting a good outcome. This is the best way to learn because the lessons are in the losses you make. And this will help you easily move from a get lucky trader to becoming a surgical trader, where every trade will be a win, no matter how little the size of profit is. At least it will cover your costs and add some extras. This is how you get to the next level. You do not only track your results, but also your mindset. You track every win, loss, and emotion. That's how you grow. If you're not winning, you're not learning. And the last on the list is reflecting and improving regularly. Reviewing and assessing your trading performance regularly helps to improve your trading skills and results, and top traders know this. It helps them to understand their trading habits or behavior and improve their trading skills. They reflect on their trades and review each performance to identify areas they did well and areas they were less efficient. Efficiency is how well you execute your plan. If efficiency is low, it means you're not getting the result your plan or strategy offers. It does not necessarily mean the strategy is the problem. It is the person executing the plan. And when efficiency is high, it means you're making the most of what the plan or strategy offers. But if efficiency is high and your results are poor, then it means your strategy needs work. And then you will need to go back to your journal to review the documentation. So when you identify your strengths and weaknesses, you learn from the mistakes and improve your trading system. This is where you want to ask yourself questions like, am I profitable or unprofitable in the long run? Am I consistent or inconsistent in my trading results? Am I following or violating my system's setups, rules, and risk management? Am I executing my trades well or poorly? Am I making any common or repeated trading mistakes? Am I experiencing any positive or negative emotions that affect my trading? So if you are satisfied with your results, then you can give yourself a tap at the back and congratulate yourself and celebrate your achievements. But if you are not satisfied, then you can identify the root causes of your problems and address them. So you need to regularly review your setups, rules, and risk management to make sure it is aligned with your trading goals, style, and personality. So now you can see that traders don't lose money because they use the wrong indicator. They fail because they never built the habits to stay consistent. Traders lose money because they were never truly prepared. lack of capital, no real plan, poor risk control, emotional decision making, and impatience are the 5 most common killers of trading accounts. And guess what? They are all fixable. But fixing them takes more than knowledge. It takes humility. And applying this formula of learning, practicing, managing risk, documenting, and reflecting on your journey will help you a great deal. The truth is, most of what traders need is already free. A simulator, a simple journal, a strategy you understand, and a commitment to track, review, and improve. So you do not need more information. You need more repetition. So now that you know the truth and you know the path, are you ready to join the 10%? Remember to start smart, stay disciplined, and trade with purpose. Now tell me, what's your biggest trading mistake so far? Let me know in the comment section. And please don't forget to like, subscribe, and share. And I'll see you in the next video.